Welcome to another compelling episode of World Ledger with Coco Key. This is your gateway to fresh global perspectives and insightful discussions. Whether you're a curious mind, a global citizen, or a lifelong learner, you're in the right place to discover how blockchain innovation is shaping the world beyond your borders. Everything on this podcast is for informational and educational purposes only. It represents personal views and opinions and does not constitute investment or financial advice or recommendations.
I'm glad that you can join me in this conversation. Please tell me about your background and what led you to launch SynFutures, because I'm always curious about the founder's journey. And all founders have very different stories, but very inspiring. So what is yours?
Thank you for having me. It's a long story. I started my career in traditional finance, working as structured derivative sales and trading with Deutsche Bank before I moved to a fintech company, Alipay, where I built their first versions of FX centers and later on blockchain consortium platforms where we enable remittance in between Hong Kong and Philippines. So that was when I grew lots of interest and I learned a lot about blockchains. That was also the time when I decided this is my career. I would spend the foreseeable years into the blockchains industries. So I became head of the blockchain platforms for Bitmain and later on founding partner Matrix Ports, leading Asian crypto platform. But my interest has always been with what we call true Web3, building something powered by blockchain instead of working a more centralized venue. So that's the reason I started SynFutures.
And what problems or pain points did you have when you launched SynFutures? Because it is a DEX, my understanding is it's a decentralized exchange. So why did you want to do this? I understand that you want to have something that is Web3 and decentralized. So is it very different or important to have a decentralized exchange than a centralized exchange?
We know that there's lots of problem with the existing financial system, like the openness, right? Like all the users have very high entry barrier for different products. And a centralized entity could determine whether you are able to trade and what product you are able to access to, what services are available to you. Centralized entities would do everything back in the curtain where you have no knowledge where your money goes to, right? But decentralized platform could solve all these problems. When I started SynFutures, the DeFi summer came in the spot field where Uniswaps and other pioneers really bring revolutions into the industries, make it accessible to lots of different people, but there's a lack in the derivative space. I would say that until now, the decentralized derivative space are just taking off with their advanced developments in the infrastructures and the user tools by empowering everyone to have access to the markets and their asset class that they would love to trade. Transparency is very important for the whole industry. That's the reason why we started SynFutures.
A lot of people in the industry know Deribit and dYdX. How different is your platform from Deribit or dYdX, for example?
You point out very good examples. These are three categories right now in the market for crypto. One, Deribit. Deribit is what we call a CeFi platform or centralized crypto platform where you wouldn't have knowledge on where your fund goes to, what happened behind the scene, and the platform have full control of your fund. So that's Deribit. And dYdX also pioneer in the I would say sort of like CeFi and DeFi intersect where they have their order book off-chain, which means that all the matching engines, all your order will go through a centralized server first before the settlements happens on chain. And for SynFutures, we pioneer in a fully on-chain fashions. Everything happened in a public blockchain, including all your trade, your matchings, your P&L calculation, your market making, everything. And you have full visibility on what happens behind the scene, where how the market maker call your price, how they do your liquidations. So that is three types existing derivative in cryptos right now.
How do you three compete in terms of, for example, spread or transaction fees?
Honestly, I wouldn't say that it's competing. Right now, this market is still small, and then there's lots of potentials, and we're trying to grab the markets of traditional ones, which is much larger than the right now the crypto market. So we wouldn't say that it's competition. But in terms of product differentiations and target users, I think like the three platform has very different clientele. Deribit specialize in fact in options. Most of the traders come here for options, although they have their futures trading pairs, but still option is the flagship product for them. For dYdX, I would say they also give us lots of inspirations. They are what we call OG platform, where they're pioneer in their like decentralized derivative. While we understand that right now, mostly the users are institutions on dYdX. And for us, we have a mix of both. We use a fully decentralized model, and their order book function or their most capital efficient functions on our platforms. We have this Amazon model. We attract more retail and small to mid institutions to do arbitrage on our platforms. Yeah.
Can you repeat the last one? Because you said that you are more the Amazon model. And what is the second half? I didn't catch.
Yeah, we are more of an Amazon model where we really put these like 30-second listings of assets as our key feature. Everyone will be able to come over here, provide just one single asset to list any pairs, while Deribit is a centralized or high-end store model where the platform itself determines what is available to users. And dYdX for a very long time also use this high-end model where they determine what is available for the users, although that recently they just add a little bit elements of the permissionless listing into their product, but still the high-end model is still at the core of their business.
When you say your model is Amazon model, everybody can come to your platform and list products and assets. How do you, because without the vetting process, how can you guarantee the quality of the listed trade pairs or assets on your platform?
Yeah, that's right. That's a very important question to ask. What we learned from Web2 is this: no platform, no single authority have the knowledge to determine everything for the users. In our platforms, they're very open, where everyone will be able to list anything, and we let users decide what types of assets are valuable for them. Over time, we listed like 300 different pairs, but some pair would naturally die out if the asset does not perform well. So that's one part. But of course, at the same time, we cherish the user experience and hope to protect them. So we add some rules, multiple blacklist. If the token does not meet certain standards, you will not be able to list that pairs. If the liquidity is not there or there's price manipulations, it will be delisted by our algorithm as well. So it's more about the open platform as the base, but we will add some government rules to protect our users.
Your model is similar to a democracy model. So let the people decide. You just provide some guidelines.
That's the idea.
So for a traditional derivative market, it is around 550 trillion to 600 trillion. That's just my guess. So how big do you think is the crypto derivative market?
I'll have to admit that I don't have the number at hand right now. For last year, the decentralized derivative protocols only taken less than just single-digit share of the total crypto derivative pair, so it has great room to growth. One of the most important problem hindering the progress is the infrastructure. Right now, the chain speed is not fast enough, and the gas fee or transaction fees on a public blockchain is still high relative to the zero cost centralized platform. I expect decentralized to take flight very soon.
What is the biggest hurdle, in addition to the gas fee, for the adoption of decentralized derivative market?
I still feel like the number one hurdle is the block time or the speed of the public blockchains. Even though we have lots of layer 2 public blockchain for past years, as you might have noticed, I will have to say that like none of the live ones can support institutional grades or financial grades transactions. For example, in the EVM space, blockchains are a good layer 2 that right now attract most capital, but the block time is 2 seconds per block, which means that like for you to sort of submit the transactions, at least it takes you 2 seconds. And you compare to the millisecond levels of centralized ones, this is very hard to use. It also limits the market makers' capability to quote very good price to their users, because like you'll be worried that, okay, if I have good price there, and what happens if after 2 seconds the market move, right? So this is, I would say, the number one bottleneck right now for decentralized derivative like us. I see good promise as Base is launching upgrades to reduce the block times by 10 times, and then Monas, Megas, Pharaohs, all those high-speed EVM blockchains are coming later this year. We are very excited about that.
Which chain does your exchange sit on?
Right now, I'm mainly on Base and taking over 50% of the total trading volume served on Base. Yeah.
Did you start with Base or gradually migrate?
Yeah, we'll gradually migrate. When we start, I would say no meaningful layer 2 back then. Our earlier versions was with Polygon mostly. Later on, we got a lot of support from the other blockchain Blast. It's in Base that we found lots of very organic user activities and good capital inflow. And we've been building on Base for quite some time.
I noticed that your platform's trading volume increased significantly with the V3 version. So what contributed to the surge? Did the migration to Base contribute to the surge?
I have to say that like it is only in version 3 where we found a product market fits. Earlier version we test out different models, and version 3s, I mean after this trial and errors, we came out with a model that number one, that is completely open, permissionless for everyone to lease any asset. But at the same time, we pioneer in introducing the fully on-chain order book. So order book is there types of market making strategy where all those professionals could come and provide zero slippage liquidity to give you the best trading experience. Throughout the year, we've come to understand that for the major pair BTC, Ethereum, the professional market makers are the major liquidity providers, so they could utilize the order book. While all those long tail assets is best handled by what they call AMM, or automated market maker, where a user just deposit funds and then their algorithm will help you make the market. So like with these new models, it works very well, like in terms of capital efficiencies and market makings and user experience. So that's when we found the best product market fits and grow significantly.
Do you use AI on your platform? Everybody's talking about AI or agents. How about your platform?
I'm personally very excited about AI as well. For SynFutures derivative platform, we haven't integrated with AI, but as we expand right now, SynFutures also have our sports aggregator launched recently, and we have this new framework called Cynthia, where we write the whole framework to be suitable for Web3 and powered by AI. So we just launched this AI-powered infrastructure for DeFi recently. And right now, you'll be able to just do trading through natural languages. Say, for example, you just add this thing there and say you want to buy 10,000 Ethereum versus USDC. We will help you find the best route, best price, split the order for you when necessary, and confirm the trade within seconds. So what you have to do is just tell us. This is the first step. This year, we're going to introduce power trading strategies for the users, where they will be using the AI to do arbitrage, to detect the market, to understand and research the markets before they make any trade. On third phases, we're going to launch this, what we call meta agents, where agents could create agents for you to trade on DeFi. You have some very talented PhDs who are experts in the fields, and whose article also admitted by all those top journals and top conferences to pioneer in the sectors, integrates AI and Web3, and provide a better trading experience. Yeah, there's something working on as well.
Fantastic. I want to zoom in on Cynthia a little bit. Cynthia itself is similar to, for example, ChatGPT in the beginning. You can just ask Cynthia to place a trade for a customer, and then Cynthia also execute the order.
The first generation AI and crypto that you see in the market are mostly, I would say mostly Web2, where the utilizations of AI is mainly just help you to do the Twitters and the message utilizing GPT, right? But what we see is that there is great opportunity in a true Web3 integration with AI. For Cynthia, I think the large language model, we are still using GPT, Geminis, and all the others. But we're building the middle layer for the Web3 industry, where we would introduce lots of Web3 intelligence able to execute the trades on blockchains, because we're in DeFi, so we know what types of transaction user like. So you'll be able to integrate and trade on. And also we will add lots of Web3 intelligence. For example, data on Web3 is everywhere. You need to introduce an on-chain, let's say data cleanings and data listening techniques into the AIs. We would, of course, incorporate the Web2 element, where we would trap all those important Web3 specific knowledge and build the knowledge base for Web3 for general LLMs. With that, we build a Web3 specific AI. So hopefully to have an intersex of AI and crypto.
It's encouraging to see this real use case of AI and Web3, because people have been talking about this, and I try to find real use cases to justify the potential. This is so encouraging. Would you consider, for example, spinning it out in the future? Because you can also sell it to other institutions if they need this kind of solution, right?
I think as of today, we haven't considered that. For us who's been in the DeFi and believe in DeFi, we see true opportunities and potential in AI and crypto intersects. At first, I pay attention to it because I understand it's so hard for users to use decentralized products. They have to download MetaMask and remember all those faces. It's so hard to do bridge and transactions. We build it as the next generation UI for DeFi. I draw lessons from Web2 as well. The very important questions for all the Web3 founders is, how could we beat centralized platform like Binance and JP Morgan, etc.? It's so easy to use, right? And although we trust the merits of decentralized platforms, the user experience of centralized platforms is so good that it's hard to compete with. I realized that similar to Web2, you could draw the lesson in Web2, right? How do you beat Google in search? The answer is never coming up with another search engine, but be a GPT. When AI comes into size, I'm excited about the potentials on offering even better user experience for decentralized users. If the AI agent could help you handle lots of complicated, like help you make the decisions, help you push all those informations, in a decentralized world, you'll be able to offer even better user experience than the centralized venue with all those advantages that you have, right? Because, for example, Binance wouldn't open its products to integrate with Coinbase. And Kraken wouldn't work with OKX to offer a very good user experience. But in decentralized platform, this is the advantage that we have. We could work with the whole chain to offer the best product for our users. And then if AI come into place, I believe that it would help users having a much better experience in trading DeFi, derivative, sports, and your wealth management, etc. Right now, we feel that AI is the next generation UI UX for DeFi. There's lots of synergy between the two.
It's so true because the UI UX of decentralized platforms, they're scary to a lot of people. I try multiple times on different platforms. I cannot deal with this. This is too much for me. So I totally can resonate what you said. If AI can solve this problem, that would be wonderful.
Yeah. Right now, I think that it's just our first, right now we launched a MVP product. You don't need to do anything now. You just deposit a little bit fund into the accounts through like scan QR codes and you don't need to worry about all the different steps. Right now, you could just type, say, buy me, whatever, and then I will do everything for you. So that's how easy it is. Just try it out. But it is a very preliminary alpha versions. We have completely like rewrite the whole framework during the past months, and we'll be able to launch a much more intelligent thing there within the next 1 or 2 months.
Besides the current products that you offer, the derivative products, do you have any plan for other products? And when it comes to market potential, which grows faster, the crypto native products or, for example, RA or real world related asset classes? Where do you see the faster growth come from?
For us, besides derivative, there's two pillars for us right now. In the DeFi world, we are building a super the app. We launch our sport aggregators. We'll have our sports as well as the wealth management products to be launched this year. And then and also the AI framework tailored for Web3 and with Web3 intelligence, as I mentioned. And in terms of the crypto native product versus RWA, I think I might be biased because I'm offering the crypto native product. If you count stablecoin as the RWA product, I feel that this is the number one use case in crypto for real world right now. And it is the single killer app for decentralized finance, if I would say that. But outside of stable coins, I'll have to say that I would see lots of difficulty in true RWA adoptions. I'm not saying about the size and the growth must be significant with all those large player and traditional finance players coming into place like BlackRock's. But I think that right now the problem facing RWA is that they are mainly using blockchains as the infra and technologies to offer to the same groups of investors, existing users and existing buyers. So that's sort of a more of a top-down approach where all those resourceful company like BlackRock issue the RWA assets, gold, commodity, real estate, private equities, and private credits. But I think the true growth for Web3 is by issuing on blockchain. It could give you more users, better access. That is the whole purpose. But I would say there's lots of hurdle in front of that. Because I was working for consortium blockchain before, and I tried RWA, tried to do trade finance RWA, and then find out that Many existing parties do not want it to be transparent. Many existing parties do not want everyone to have access, because this is how they earn their incomes and make their profits. It's not about technology. It's not a technical problem. It's more about complicated traditional world's interest parties problems. And so if you want a bottom-up approach, it will be very hard to do that. So RWA right now mainly rely on the existing relationships and existing users to use these technologies to improve it into a 24/7 trading market. That's the difficult part for the RWA that I'm seeing.
It's very insightful because that's actually some of the builders' observations. Exactly as you just pointed out, WA is mostly used by large institutions which distribute new products to the same distribution network and the same
Yes.
users. The benefit of RWA right now is mostly cost cutting versus identifying new users, new markets.
One of the lessons that I learned throughout the year is that when you sell to a department of a company, saying that you need to invest to save costs is a very hard sell, because no one see like the real cost cutting, number one, and then like you will have to invest first for the cost cutting, right? So it's a very hard sell. And secondly, you will be touching lots of interest groups, different departments, that will make it even harder. So the reason why some of the most advanced technology innovation happening in the crypto native part comes not in the cost departments, but in the like business departments, where you create new business, where you drive new growth, and that's a much easier approach for like innovation and will attract more talents. And I think that's also the reason why lots of innovation would happen in small companies instead of large companies. I would say that's good in that lots of large institutions are paying attention to RWA, is bringing capitals and educating the whole market for the treasury yield related, backed by US Treasury that could act as a stable coin with you for the crypto have some market demand. That's my take on this.
Thank you. So let's move on to the next question. I'm very curious about your token because you did not issue token in the beginning, and recently you decided to issue F token. What changed your mind, and why did you see the need to have your own token?
I still believe a token should be issued after you find your product market fits. And lots of founder I know issue the tokens and use the token as incentive to attract users. But the problem is that if you don't have, I would say the token is not there for free. If you hand out token to your users, it's kind of a marketing cost, just like in the Uber days where we will have a subsidy for your users, right? But if your products haven't have product market fits, user will come, farmer will come, and they will leave, and then leaving you nothing at all, and then it will jeopardize the whole company and project's development. So we didn't issue a token as we haven't found product market fit in the initial years. With V3, we do see the true adoption of users. So that's when we decided to launch the tokens, also reward our early users and DTs, and with the tokens, we will be able to design more incentive program for our users.
Token could be double-edged sword. If you issue it too early, it could become a burden. I talked to some founders, they regretted issuing the token too early. Just as you pointed out, they haven't even got a product market fit and issue the token. A lot of users just came for the token, and once they cash out, they're gone. That is the challenge. Good point. Let's switch to regulation part, which is maybe not as exciting. Help me understand how DEX is regulated in Singapore these days.
I would say there's no formal regulation right now. For us, we completely banned the Singapore and US and all those jurisdictions that might not be supporting decentralized exchange without licensing. So we're only operating on those jurisdictions that does not have explicit ban on their decentralized. And we're hopeful that with the Trump administrations and the recent regulation shift, there will be a chance for us to offer the product to more jurisdictions.
You mean you are hopeful and have plan to offer to U.S. users if the regulations have more clarity in the U.S.
On Base Network, it is happening. In the past few days, they just announced this verified pool to enable US users to participate in Uniswap. This is how the DeFi space could be regulated. Essentially, you just offer some pools specifically for KYC and ML users, and only those KYC and ML users, say of Coinbase and other vendors, will be able to access your products. Easy for us to add features into their product right now. Yeah.
That's good to know. So that means if you want to offer to US users, you can use Base as long as you meet the Base requirement of AML KYC, and you would be okay.
Yes, they integrate it into their wallet. For example, BTC is a decentralized product. But you still have access to BTC because you do KYC via Coinbase or other vendors that offer the services for you to register and pass the regulation, and then you can buy BTC. Similarly, in decentralized finance, if the regulation become more clear, lots of like wallets and KYC providers would do KYC on you. Once you pass the standards, you'll be able to access DeFi products. If not, the DeFi products, all those pools would not be open to you. That's how it works.
Another question for you, could be the last one. When you look back at all the things that happened and all the progress you made with SynFutures, what would you do differently if you had a chance to redo everything?
That's a very good question. You know that recently we'll have the debates. Last year, we already have this debate on the model. I feel that we might have been too optimistic on the infrastructure's improvements. Until today, I would say that all the public blockchains, EVM at least, that's not able to support institutional grade DEX right now. We're being stick to fully decentralizations. We're the first ones and the only one that's offering fully on-chain, even matching order books. So there was debate last year and even today that whether we should introduce some types of centralized element into it. Do people really care about decentralizations? Would it be better if we introduce some centralized elements to improve the user experience? For example, some of our peers right now in their market use a more centralized chain built by themselves, and they will be able to offer much better, I would have to say, much better user experience than us. Our belief for the past year has always been that like grow the industries, trust the infra, and be completely transparent on chains. There's lots of discussion within the team whether we should stick to that and whether we should care more about the user experience. But I would say that the conclusion for our team is that let's have another try this year, where Moda is coming, Base is upgrading reducing their block times, and lots of good infra is coming up. And if that could work, we'll be able to really be fully decentralized while at the same time offer the best user experience and does not compromise anything for our users. So that's something that's stirred very fierce internal debates now.
But if the infrastructure couldn't improve as fast as you expected, what would be next?
If not, then we are thinking about building our own chain. It is also a blockchain, but the nodes will not be as decentralized as public chain. The chain will be dedicated to us only, where we'll be able to offer zero gas fee, high speed, and good liquidity for our users.
As a female founder, do you find it hard throughout your whole journey? Do you have any second thought which you did not strike out on your own?
In fact, I feel I'm at an advantage as a female founder because there's so few female founder out there. It's easier for me to schedule meetings. The second advantage of a female founder might be because of our nature, there's less conflict in the management team where we'll be able to coordinate with other people. But yes, I feel like there's a lack of female founders out there in the crypto markets. One disadvantage definitely that I found is that if you go to true like crypto native talk, I often find it hard. When they talk about gaming, boxing, this is not something that I could speak for.
You have all my respect because I haven't come across too many female founders. It's very exciting that I have this opportunity to talk to you. Wish you all the best and SynFutures all the best. And I will stay in touch and look forward to learning more about your company and the progress.
Thank you so very much indeed.
Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.